how that's all traveling along. But in terms of 2004, it was probably the year of adversity for me in terms of my sporting career. So I went into 2004 after winning in Sydney and kind of achieving a lifelong dream of winning Olympics, and particularly a home Olympics. And I actually thought I'm going to do everything right. Once that calendar clicked over to the 1st of January 2004, I was going to make sure I was in bed early, wasn't going out anywhere. I was going to make sure I never missed a training session, do everything right. I normally did that, but on those particular years, you want to make sure you get everything right. And I got into, sort of my training and racing throughout the course of January and was going particularly well. And then I got a little bit sick. I got a sinus infection, but I made that commitment where I wasn't going to miss a session. And, the one thing you have to do in sport is you've got to make sure that every time you show up, you're doing it not just as best as you can, but it's almost got to be above and beyond that. If you want to be the world's best, you've got to make sure that you're doing it better than the guy in China or over in the US or from Germany or the UK or whoever and wherever your main competitors come from. And so for me, when I got that bit of a sinus infection, I just kept training, and that just got worse and worse and worse and progressed down to my chest. And got to February a couple of weeks later, and I woke up with a temperature of 41 degrees and with pneumonia, and got taken to hospital because I just trained myself into the ground. Our training schedule is usually about 80 kilometers a week. We train 6 to 7 days a week. We do about 9 hours in the gym on top of all that water work too. 9 full meals a day. So you're just constantly bringing in calories because the amount of energy that you're burning. I had the Olympic trials in March, made the Olympics, qualified in all my major events, the 200, 400, 1500 meter freestyle, and then had this chronic chest infection. And I ended up going through 17 courses of antibiotics in between the Olympic trials, which were in March, to the Olympic Games in August over in Athens. And I ended up getting 2 silver medals earlier on in the week by 0.1 of a second in both of those races. Ian Thorpe just pipped me in the 400 meter freestyle, which I really wanted to win because he beat me at the World Championships just the year before. And we were always very close in that race. When I got to the 1500 meter freestyle, I was on antibiotics throughout the course of that week because the infection really starts to flare up. And the Olympics is one thing to deal with physically. Obviously, you see athletes performing at their physical peak, but it's the mental and emotional aspects that really get underestimated. And I think that's why it's rare for an athlete who can win world championships or break world records, but to win Olympic titles or back-to-back Olympic titles is so rare because of that other element that is just so difficult to manage and so unexpected, the size of that weight that you have to deal with. I mean, you walk into an Olympic village and it's like a circus, right? You go into the dining hall, you've got little gymnasts who are kind of 4'2", you've got basketball players that are like, 7'2", and then you've got, the dream team sitting over there. You've got Muhammad Ali walked past me in the Olympic Village in 2000 when I was just sitting there having lunch. I remember in 2008, I had Rafael Nadal and Federer sitting at the end of the table, one seat in between us, and the two of them were just having lunch together. So it's an incredible place to have to, sort of be amongst that crowd and perform at your absolute best. And then the scarcity of it because it's once every 4 years or 5 years, with Tokyo in that scenario, that makes it so special. So for me, going into that 1500 meter freestyle, chronic chest infection, on antibiotics, 2 silver medals by 0.1 of a second, I was kind of took the attitude, whatever it takes in that race, and ended up, winning the event and breaking the Olympic record. It was the toughest race that I'd ever swum. And it was the closest race that I'd ever swum. I'd won for 8 years straight at that particular point in time. I'd never been beaten in a 1500. And the closest margin I had in the 1500 meter freestyle was Sydney 2000, which was between Kieran Perkins and myself, which was 5.5 seconds. I went into the last tumble turn, and the guy out in lane 6, I was in lane 3. We turned together, and there was only 0.16 of a second between the two of us. So we basically turned 100% together. And I ended up pushing off, and I remember saying to myself, whatever it takes, and got on top of the water. And in the last 100 meters, I swam a time that was faster than when I broke the world record. And I think that proved to me the power of competition, because I was feeling the worst I'd ever felt at the 1400 meter mark of that particular race. But that competition there, and the guy I was up against was a phenomenal athlete. Just to give you a bit of an insight into his CV, this guy, Larson Jensen, he's won multiple Olympic medals. He was breaking the American record in the men's 1500 meter freestyle by 11 seconds that day. He, after his swimming career, he always said he wanted to be a Navy SEAL. I remember receiving an email from him one day, and he had the signature on the bottom said Chief of Commander, SEAL Team 5. So he was running SEAL Team 5. Ended up doing an MBA at Stanford, and now runs sort of funds management and private sort of firm over in the US, I think based out of Silicon Valley. So it's in the sort of tech space. So he's an incredible competitor and high achiever. So I was going up against him, but it was funny. I was able to do my fastest split ever, still to this day, in the last 100 meters of that race because of the desire to win. And ended up coming back to Australia. Had been basically sick for 8 or 9 months, and went and saw another chest specialist because the guy I was seeing, I don't think was getting to the bottom of it. And they put me under a CAT scan, and they said, "Oh, there's a big lump there on the left side of your chest." And I was sort of had things going through my mind. I thought, I've overdone it. I've overtrained. I've created a massive problem and issue for myself, and ended up being injected with iodine to see what the lump was. So they took me out, put me back under, and they said, "Oh, it's all fine." And I said, "Well, what's the lump?" And they said, "Well, because you've been blocked with mucus for so long, that lower left lobe sitting here has been getting no oxygen to it. So it's just gone up into a ball, and it's just sitting there in a ball, and that's what the lump is." So I'd lost kind of 25% of my lung capacity because of that infection just blocking my airways. So it was a race that was extremely difficult and overcoming adversity. But I think the power of the mindset, depending on how important the outcome and the purpose is to you, really drove me to put myself through all that pain, to be totally frank.
And how's that? Just how does an elite athlete or a former elite athlete handle lockdown? Has that been a challenge? And I know you've got a couple of young kids going through homeschooling as well. So
yeah, it's to me, it's all about structure. That's the first thing I focused on. We can all go through our mental ups and downs and challenges, and some days are like rocks, some days are like diamonds, I think. And talking about world records, we're sitting a world record, I think, for Melbourne now or tomorrow, I think, in terms of the number of days that we've been in lockdown. So for me, I really focus on structure. I might add, the first 3 months last year were hell. We had a 10-year-old at the time who kind of wasn't young enough just to do his own thing with homeschooling, but wasn't old enough to get how all the technology works and to upload files and send things in and do exams online. And we just had a baby as well. So we literally had a 3-month-old in the house, a 10-year-old trying to do. So it was pretty challenging. And then, I'm CEO of a business and trying to run in markets that were, the volatility was extreme, particularly in March last year because of COVID. So, it was a very, very stressful time. And as soon as things settled a bit, I realized the most important thing for me was structure. So I actually moved a whole heap of gym equipment in the house, made sure I got up early each morning, did my gym, got some exercise in, made sure I structured even gaps in my day where I would normally move around in the office or do other things instead of sitting in the one room, because I found myself sitting there working really, really late, which was unhealthy as well. And then disciplining myself to make sure at least every day I got out and did a walk or a bit of a run at the end of the day, just to decompress a little bit. And I found particularly that lockdown last year really challenging, but the one this year, and touch wood, I've found much easier because I was able to slip back into that routine of structure. And I think also, my wife and the kids know how to do it as well. So there's kind of less stress in the house, full stop. We don't want to be there for forever, let me tell you, but structure was the big key for me, and also acknowledging the hard days, because I wasn't very good at that. I'm hopeless at being vulnerable. So acknowledging hard days and challenges makes them a lot easier to overcome them.
Cool. And last question before I let you get into your presentation, but given you were era of the fast suits and full length suits and things like that, how long does it take a big bloke like you to get in one of those suits?
Yeah, it was funny. I mean, the real era of those suits was kind of 08, 09, because Speedo went to NASA and got the head at Harvard of computational fluid dynamics to come together to test on the plates at NASA the fastest material through water. And that's what they developed. And world records were getting broken left, right, and center. Before that, we still had the old kind of cotton suits, you could say. So they weren't really doing too much. Some people wore them, some people didn't. But those suits, if you looked at them, if I laid them on the desk right now, they kind of look about, I don't know, you see like that, about that big, about probably half my body. So they have to stretch incredibly long distance. So I would have 3 people at a major meet with rubber gloves on, with surgical gloves on. So you'd have the latex gloves and pulling it up so they wouldn't put a hole through it because it ends up being so thin, pulling it up, trying to help me get those suits on. And they'd be doing it in little bits. And in fact, to give you an example of how tight it was, Ian thought would have to cut himself out of his suit each time. That's how tight he had it. So he was really lucky he was sponsored by Adidas because his suits were so tailored for him that they would cost something like £2,000 or £3,000 a piece. And he would compete 9 to 10 times and use a new. Sometimes he would get the heat suit off, and I think he's reused that before. But all his final suits were all new, so it was a very expensive week for Adidas. But he did pretty well, so they got good advertising out of it. But
absolutely,
yeah, that's super tight.
Yeah. No worries. All right, I'll let you get in the. I don't want to monopolise all your time, so I'll let you get into your presentation.
Yeah, no worries. Well, I'll just share my screen with everyone, so I'll make sure that's all working. Just give me 2 seconds. The challenges of 2020 and 2021. Where are we? Just here. All right. So just for everyone's interested, a little bit of background. So David already alluded to it. I was always interested in financial services. So even when I was swimming, I made sure that I was studying commerce law through those years. I was actually meeting with some senior people in banking. I was fortunate enough, to be sponsored by Westpac at the time. So I was able to get some good guidance and mentoring in terms of getting into the industry. And it's kind of going back to 2003 now. So it's a very long time ago. So I was always interested in this space. And really the reason I got into Generation Life is because my former BT CEO, who's been the former chairman of MLC, is the current executive chairman of Colonial First State. So very well-credentialed, smart, driven individual, saw an opportunity in this business because of after-tax returns. So after-tax returns is really big overseas. Predominantly here in Australia, we really only know it within superannuation. Of course, there's a lot of changes to superannuation and a constant narrative around superannuation. So we saw an opportunity back in 2017 when the government put in lots of caps and some major changes in there to really look at what are the other structures from an after-tax point of view that people should be looking at as part of their overall holistic wealth planning that we could bring into the 21st century, make some changes and look at those flows outside of super. And a lot of people don't want to put all their money in super now because of the preservation age, because of the caps, and because of the constant narrative around change. So we've seen a huge uplift within our business, and I'll take you through that over the course of this presentation. And what else I'll do is I'll touch on the key features without sort of overdoing it, because when it comes to an investment bond, there are a lot of features and aspects and strategies that you can actually use it for. And then we'll go into some case studies, because I think the case studies are a great way to actually bring it to life. And you'll probably have situations that'll feel pretty consistent or familiar in relation to those case studies that you could start thinking yourself. And of course, this is all kind of general advice from our perspective, because we don't know anybody's personal situation, but I'm sure some of these scenarios and some of the features that you'll see an investment bond can actually solve for are quite incredible and not often kind of mainstream or well known about. So just moving through the slide deck, tax effective investment strategies is what we're all about at Generation Life, and innovation is one of our core values. So this is a little bit about us. We've been around for a couple of decades. Like I said, I joined the business back in 2017. We have the most flexible investment bond, and I'll talk about some of that flexibility. So there's 2 core things to remember. One is that we're the most tax effective structure outside of superannuation. But with the most flexible investment structure, full stop. And I'll go through some of that flexibility that you have throughout the course of this slideshow. So we offer a very broad investment menu. So it's not just one investment choice. You can go into any asset class. You've got multiple options within each asset class. You can construct an entire portfolio that can be global shares, it can be Australian shares, it can be cash, it can be fixed interest. So you can really put together a whole portfolio, which is what we work very closely with financial advisor with and their underlying client base. When I joined the business back in 2017, we took about 15% of total market inflows. So that's money coming in on an annual basis. We now take over 40%. And on the latest data, we actually took 46.9% in the last quarter. So we're definitely the market leader in this space. And it's because of all the innovation and investment that we've brought to the product and to the business. We're highly recommended. So there's 2 core research firms that research financial products within Australia. One's called Lonsec and the other one's Zenith. We're the only provider that's highly recommended from both. And that's because of the way we structure our business, because of the amount of excess capital that we have in the business, and the business has no debt either. So it's a very, very safe balance sheet, I like to call it. We're the market leader in tax-aware investing. Now, that doesn't mean much, but what tax-aware is basically going, how do you actually maximize your tax benefits inside your structure? So as an individual, you get all your discounts and your tax return and all that sort of stuff. It's very much that's what tax-aware investing is inside the investment bond. So we have a different set of tax rules that we can cater to, and we've been able to bring our effective tax rates down from, kind of 26 or 27% with a headline rate of 30%. Down to the mid-teens, or some of them as low as 9%, even inside some of our investments. So we're very good at being able to manage the tax position within the tax rules that we have around the investment bond structure. So we're the real innovator in that space in terms of what we're doing there. And in fact, we've already been nominated for innovation to the AFR Boss Awards, which is coming up in October, which is a real great compliment to the people within the business. We've written over $2 billion, well over $2 billion in investment bonds. We continue to get record, quarter after record quarter and record year after record year in terms of those total inflows. We have two key regulators. One's ASIC, which is the group business, which is a listed company called Generation Development Group. The subsidiary business, which is a life company called Generation Life, is regulated by APRA. So very stringent rules and capital requirements there, which I guess makes investors feel very safe around their investment, because their only underlying risk is what they choose to invest in. That's it, not our business as such. And another thing we really pride ourselves on is our service proposition. We've been growing exponentially over the last few years and hiring at a rapid rate. In fact, even since the start of this year, we've hired over 20 new people within the business, but we have everything onshore. So all of our client services team, all of our administration team, all of our product team, all the people that do the pricing of all the investments, all sit here in Melbourne or Sydney. So there's nothing that we currently offshore. Okay. So that was a little bit about, I guess, Generation Life as it stands in terms of the overarching business. Now let's talk about investment bond. What is an investment bond? So an investment bond is purely an after-tax paying structure. That's all it is. So like superannuation is a legal structure, like a company is a legal structure, an individual has a certain legal structure. Investment bond is just another legal structure, is the best way to think of it. They've been around much longer than a lot of those other structures that I've just referred to. And they're much more stable in terms of the tax rules and the regulation around them. And they've had very, very little change, which I think when you compare it to something like superannuation is very reassuring. So first and foremost, and I won't go through all of these, I'll just pull out a few key areas, because again, I don't want to overwhelm everyone with too much information, but we have a max tax rate of 30%. You only ever pay that if you're sitting in cash and you've got no deductibility. So, all your franking credits and everything else that you normally receive, we receive inside the structure. We pay tax on behalf of the individual every single quarter. So there's nothing to do from a compliance point of view. It's a very simple structure to administer. And we also manage the capital position of the underlying funds. So like I said, a lot of our average tax rate, particularly for our equity funds, sit within the teens. So if you're on a high marginal tax rate, there's an automatic tax arbitrage or gap that you're receiving in terms of your investment compared to your individual tax rate. So therefore, the compounding effect of that over time can be quite material. We have a whole technical team that works with financial advisors to demonstrate that too. So we'll do a comparison if they were to invest in one structure, the same sort of asset versus the structure of investment bonds, and what the differences are. And if the differences are meaningless, or another structure is better, we always say that too, because we're very conscious as a business losing our credibility by doing one poor deal that doesn't work out the way that's anticipated can compromise everything else that we're doing. Another point that I really want to talk about here is the portability one. So right in the center of the screen is tax-free transfers. So I'm sure a lot of people on the call would have owned an investment property at one point or another and sold an investment property. Of course, what happens with that, if that investment property increased in value, so went from $500,000 to $1 million, you ended up selling it, of course, you've got to pay CGT. You've got to pay that capital gains liability that you've got in there on that $500,000 of increase. And then on the other side, the person receiving the asset, of course, has got to pay stamp duty. So there's two sort of key taxes that you have within that transaction process of transferring an asset from one person or one entity to another. That doesn't happen with investment bonds. And this is the flexibility part that I talk about. The fact is, you can transfer from yourself to your spouse, your kids, your next door neighbor, someone you don't even like, and the asset value stays exactly the same. There is no taxes that are brought on by changing ownership, which is a real key aspect, because every other structure that we use, there's always a crystallization of the asset and then it gets transferred. And the reason is because we're the tax-paying entity. So the flexibility of being able to move these around, or if you've set it up incorrectly and you need to transfer it to someone else, or there might be risk because someone could be a doctor and they're worried about being subject to malpractice, even though we've got some stuff around that which does protect you, which I'll refer to in a second. But if you really want to protect yourself and transfer the asset across to someone else due to a situation, you can do that. So that, and not incurring tax liability. The other aspect of this particular structure, which is really handy, is it's creditor protected. So you can see there in the bottom, just below portability, section 116 2D of the Bankruptcy Act. Just to be very, very specific, it's creditor protected. So if you're in a situation where you do get sued and people have access to your assets, they don't have access to this one. And in fact, it's so good that you can even start taking a distribution tax-free at the point of financial hardship that is also creditor protected once it gets into your bank account and leaves the investment bond structure. So it's got some really, really handy risk management mitigants. So you've got sort of three key things that I pulled out there, and I'll touch on one more before I move into the next slide. Is one, you've got a very low tax rate and the internal tax rate of the investment. So you get a huge compounding effect in that. So you're able to increase the value of that investment much quicker because of a lower tax liability. You can transfer it around to any structure, any person that you want without incurring another tax liability. And it's also creditor protected. So from a risk management point of view and making sure that you protect your asset base, this is a great structure to be able to do that. And the last one I want to touch on, and I really want to bring this home in some of the examples and case studies that we have today, is just about being structured as a non-estate asset. So you can structure an investment bond to go to any beneficiary that you want, and you can control how and when those funds are distributed. It's unbelievable, actually, because a lot of people will use testamentary trusts or other sort of fancy tools to be able to transfer their wealth, particularly if they've got quite a large amount of wealth that they're transferring, or a complex family situation that they're trying to mitigate the potential issues that might be incurred due to that. But this is a great structure because you can set it up, it can go to one or more beneficiaries, and you can contest any asset that gets transferred. But the great thing about this, unlike an estate where you can use the estate to fight one another, you can't with the investment bond. It gets transferred to the beneficiary that you want to, and not one of these have ever been overturned. So you can have 100% reassurance, which is unlike any other mechanism for estate planning, that those funds that you leave to that individual will go to them. And I'm going to talk about some of the hows and certain situations that you might find yourselves in, and the way you can distribute that capital upon your passing. So it's a great transfer of wealth tool. So 4 key things that I really want to cover off through the course of today. All right, sorry, the computer's a little bit slow. So these are the 5 core uses that we see for investment bonds, and this is in terms of the money that flows into the structure and into our business. So to give you an example, last year we did 404 million worth of new inflows, and this is the order of priority that they came in. So one was estate planning. The next one was an alternative or complementary to superannuation. So there's some people that might have a cap. They mightn't be capped out in super. Naturally, for people that are capped out, this is the best alternative structure. But for some people that are quite young but on high marginal tax rates but don't want to put all their money in superannuation, this is a great complementary strategy. So we see a lot of businesses or individuals that run businesses that do that sort of stuff. Saving for a future need of a child. Private school fees are extremely expensive. So this is a great tax-effective way to be able to save for a future cost, or even a home deposit one day, because we all know how expensive residential property is. The next one is around trust. So a lot of people who have family trust structures have to distribute the income out every single year. And often enough, that doesn't go out to an individual beneficiary. It goes to a company because a company pays a lower tax rate. But eventually, when you want to take that money outside of a company, you've got to pay the individual tax rate. So the top-up tax, it's called, which is that 30% company tax rate to an individual rate of 47% is normally how that would work. So that's an extra 17% of tax that you actually have to pay. When you have an investment bond that sits in a trust and it's owned by the trust, you don't have that situation. You can keep the money in there because it doesn't need to be distributed outside the bond, and that can just accumulate over time. Then once it gets to a certain period, you can actually take that money out, distribute it to one or more beneficiaries. And it doesn't matter the amount of money that's coming out of the structure at that particular point in time. It'll be distributed and there'll be no more tax to pay. So a lot of our very, very wealthy clients use it for this particular core benefit. And the final one here is government entitlement. So you all have probably heard of assets testing, whether it's the assets test or income test. What an investment bond is able to do, and we structure it in a way that it's able to help produce better social security outcomes, is from an income test point of view, it is deducted from that. So, obviously we work closely with our technical team here and financial advisors to look at certain scenarios where people might have a certain amount of assets and a certain amount of income, where we can actually help bring more, pension entitlements, aged care benefits, etc., to the table by using the investment bond as part of their overall wealth strategy. Okay, moving into slide number 6. So the most tax-effective investment solution outside of super. So I've already touched on how this works. But what I wanted to do is really just highlight some of the key differences. Again, like I said on each slide, I won't go through all the detail of all the various points of difference, but you can see here, first and foremost, sorry, we just got someone who's just come off mute there, who's having a bit of a chat. I don't know what I might do is try and...
Just make your camera and people will...
So, sorry, we just got someone who's just off mute, who's talking. There we go. That's great. Thank you. So you can access to funds at any point of time. So a big difference between us and superannuation is the fact that you've got to wait for preservation age for super. With this particular investment structure, you can receive tax benefits, but if you need to access your money, you can do that at any point in time. The next one I'll refer to is just legislation. One thing about super, I think over the past 20 years, there's been over 200 changes to superannuation, and more recently, 6 major changes back in 2017. For our structure, we've had 1 change in 20 years. So, we can't predict the future, but on the empirical sort of evidence and data, it demonstrates a very, very stable structure to invest with. Death tax. So whenever you set one of these up and you're passing on to a beneficiary, doesn't matter whether that beneficiary is a dependent or a non-dependent, there is no tax to pay upon that being transferred, where in superannuation, there are taxable situations. Ownership transfer, I already referred to that and the flexibility of what that looks like. I'll move on to the 4th last one where it says tax paid. We've got a max tax rate of 30%, and a superannuation structure, of course, has a max tax rate of 15%. So naturally, it's a better tax environment, and sort of we never argue that. But bonds is certainly has a place in your overall wealth picture. And you can see there, tax-free access and distributions, no tax reporting, so very cost-effective to run, and being able to switch without incurring CGT. So that's some of the core differences between us and superannuation. So what we'll do is we'll kick off with some of the case studies that we've got for you today to really highlight some of those features and how an investment bond can actually help support some of your overall strategic intents or some of the outcomes that you're looking to drive with your own wealth. So here, and I'll try and take my time going through this so you can digest all the information along the way, but we've got a 41-year-old self-employed builder who currently earns $135,000 a year. Might I add, these are all case studies that we've had within the business. Of course, we changed names and a few numbers here and there, but these are all situations that we've actually incurred where the investment bond has been a really fantastic solution for individuals. This particular guy, Andrew, intends on ceasing work at age 55 because of the labour-intensive nature of what he does. And whilst Andrew has adequate superannuation, he wants to be able to access funds 5 years prior to preservation age, of course, when he'll be 60, of course, when he can start taking a distribution from that structure. He has a $25,000 cash surplus, and he has surplus income of his $135,000 of $12,000 per annum. So the solution in this particular scenario when it comes to the investment bond is that excess money that he has sitting in the bank account, that $25,000, we'll invest that in an investment bond. We'll put that surplus amount that he has per annum of $12,000 in as contributions to the investment bond. So you can have a regular savings plan every single month that goes into that particular bond. We'll index it at 5%. So indexing at 5%, what that means is you'll increase that amount by 5% every single year. So you stay ahead of inflation in terms of the investment amount that you're putting in there. We'll do that to the next 14 years. Why the next 14 years? Because he's age 41 and he wants to retire when he's 55. It's completely flexible. So he can withdraw that at any time. He can do it one of two ways. He can take a lump sum, or he can take a regular withdrawal amount if he chooses to. Also, given his profession can be subject to lawsuits and malpractice, that section under the Bankruptcy Act, section 1162D, is a great risk management mitigant for him to be able to have full reassurance that these funds, as well as the funds sitting inside his superannuation, can't be accessed just in case something goes wrong in his professional life. So what does the outcome of this actually look like for Andrew? So you can see here, as the slide just taking its time to roll through, you can see here just a quick recap. Andrew, 55, he retires, initial investment amount, 25K, $12,000 per year of contributions, an after-tax return average of 6.5% per annum, which is very, very realistic and achievable. On the left-hand side, where it's got full withdrawal after 14 years, if he was to take a lump sum, on that scenario, he would have $418,000 to be able to take out, with total contributions, so a total investment made over that period of $260,000. You can see here on the right-hand side, if he doesn't want to take a lump sum but wants to set up a regular withdrawal strategy, which is something we do for a lot of clients here at Generation Life, after 14 years, again, same amount of contributions in terms of that $260,000. He has total regular withdrawals of $420,000 over the period, and he's left with a balance after 19 years when he accesses his super of $78,804. So you can really do it one of two ways, depending on what your overarching strategy is and how you want to manage the flow of that money. So a very tax-effective way of being able to either transition to retirement or retire early and know that you've got enough funds to be able to bridge from when you want to retire to when you can access your superannuation. All right, moving into the next case study. So I already referred to this. A lot of grandparents in particular utilize the investment bond strategy for meeting the rising costs of future generations. Like I said, whether that's private school fees, whether that's deposits for a house one day, whether that can even be a first car. So, you know, they like to be able to support their grandchildren. This just gives a bit of a highlight of some of the costs that you have, which are quite incredible. Even just to go to public school these days, it's expensive. So you can see 75K there. Private school fees after tax cost $450,000. This is the average, whether you're in Sydney or Melbourne, for those particular fees. So you're looking at close to $1 million per child on a gross basis, so on a pre-tax basis of earnings. Tertiary education, you can see there for a law degree is $92,000. And the average home deposit in Sydney and Melbourne, and for full disclosure and transparency, including stamp duty on this, that $300,000 cost you can almost see there on the bottom of the screen, that's not including the rise that we saw this year. These are last year numbers. So it'd be quite scary to think and quite daunting as an individual coming out of university thinking, okay, now I've got to actually save up for a home deposit. And the average cost in Sydney is 1.2, 1.3 million, and close to $1 million median average house cost in Melbourne. So how do we actually solve for this? And how do we actually look at certain situations where we could help support people in terms of meeting the objectives with their kids or with their grandchildren? So we've got a great case study here of a couple of medical specialists, both in their 40s with young children. They've got 3 young children. They earn in excess of $600,000 per annum, so earn a big whack of money, and they have $6,000 per month worth of surplus income that they're obviously putting into a savings account. They're in a situation where they've maximized their borrowing capacity with the bank, and they want to be able to look at tax effective ways to invest in other structures. And obviously being on such a high marginal tax rate, if you've, putting the max in your superannuation, you've already maxed out your borrowing capacity, this structure around investment bonds is a great alternative. They have $300,000 accumulated in total savings, so sitting there in cash. And they also want a savings plan to fund private school fees and some additional expenses. Some of the concerns that Paul and Julie in this scenario have, like I said, this is a real life scenario that we've incurred here at Generation Life. They're concerned about their increasing their annual taxable income. Being medical specialists, I'm sure that's going to increase their overall wage each year. But if they're going to invest outside their superannuation, they're going to increase their taxable income by the income that's been generated by those assets. And they also can appreciate the risk that's involved with their profession, and they want to be able to protect their children's education and future, just in case they are in a situation where they're sued in the case of malpractice and they're actually compromised. So how can we actually deliver an outcome from two perspectives? One, tax effectively be able to invest, but also manage the risk side given their own personal set of circumstances. So what we do here is we establish 3 different investment bonds for their children. So they've got 3 young kids, 3 investment bonds makes, sort of a logical way to set it up. Their initial investment is $300,000 of that surplus savings that they have. So $100,000 per each investment bond. They've of course got that $6,000 surplus per month. So we divide that into 3. So $2,000 per month goes in as part of a regular savings plan into each of those investment bonds that they set up for each of those children. They're the bond owners, so Paul and Julie, so they control the underlying assets, and they've got a bond nomination in there. So each child is nominated as a beneficiary of those bonds, just in case something was to happen to either one or both of the parents, and they can assign those investment bonds for a specific purpose, and they can be assigned for a specific point in time. So if someone was to pass away early, and so that child's only 7 or 8 years of age, of course, you don't want to be giving someone $100,000 at that particular age because they're going to be taken advantage of from the person who's controlling it, or perhaps they could be. So you can actually hold that investment back and either have that capital amount come out at a certain point in time, say age 25 or a certain date or a certain catalyst, and it can come out as a lump sum, or it can be distributed out an amount per annum until the life of that particular investment runs out. So it's very flexible in terms of what you can do, and it gives you 100% reassurance that that money is going to go to that individual when it's supposed to go to that individual, and it's going to be very much protected by the legal structure of the investment bond in the meantime. Again, not one of these have ever been overturned or taken to court and successfully. So the outcome here is that we've invested the bonds in our tax optimized series, which is that tax aware series that I spoke about at the start of this presentation, which offers tax paid as low as 9%. Even some of our funds, our performance for the year just came through. Even some of the funds were even lower than that. There's no additional tax to declare in their tax returns because we're the tax paying entity. So they're not increasing their overall tax liability, particularly when you're on $600,000 a year. You don't want to be increasing that because you're going to be paying the top marginal tax rate of 47%, including Medicare. The investment bond proceeds are protected under the Bankruptcy Act. So I referred to that at the self-employed one. Now we're referring to people that are in the medical field. We do a lot of people in both the medical profession and legal profession because of this particular risk management mitigant that we have around bonds being creditor protected. The parents also maintain the full control of how the funds can be transferred to each children. So I've given the example of how estate planning can be set up to make sure that that beneficiary, whoever it may be, receives those funds, but you can control how and when they receive those funds. And it's very, very simple to set up, and we do all the administration around that. Okay, investment bonds and estate planning. So I can really start to bring this to life for everybody on the webinar today. And we always like to throw around a few stats just to highlight some of the issues that perhaps you don't see coming, or perhaps you couldn't appreciate because you probably have a pretty good family that you think will get along post your passing, and everyone will divide up the wealth evenly. So wills are very commonly contested under the family provisions legislation, and it can often, when it's very fractured and very toxic, and it can be over 12 months till you can even get into court to even start the process. And when that process actually commences, it's normally commenced by immediate family members. So you can see there on the orange bar chart, 86% are brought forward by other family members. So we always talk about bonds being a great way to be able to offer a solution that can stop this problem from happening, particularly if you've got children or grandchildren that have got fractured relationships in there, or there's a lot of money sitting within the estate that's going to flow through. And people aren't deterred from doing this because they're not using their own money to fight a will, they're using the estate. So they don't have to put their hands in their own pocket to be able to take this to court. They can spend everybody's money to be able to fight. And often it only takes one person to be able to start that process. And you can see on the right-hand side there that 74% of contested wills are successful. So they're either successful partially or fully overturned and completely changed. So moving through onto the next slide, which really talks about some of the complexities in estate planning and how people transfer their wealth and some of the conflicts and some of the potential issues that might be incurred along the way. So you can see here on the left-hand side, I won't go through every particular aspect of this, but probate can take a long time. Legal challenges, it can be very stressful. If it's going into a trust, you've got the trustee discretion, so they can change things around and not necessarily operate it within your wishes. Probably the most high-profile case of that springs to mind is the Reinhardt family. So Lang Hancock, of course, left a quarter of that business to all of his grandchildren. And of course, Gina Reinhardt was running that trust, ended up changing the vesting ages and all the rules, and you know, her trustee discretion pretty much said that they weren't receiving any money, I think, until she had well and truly passed from their own trust. So, and that of course was a 4-year court case that was heard up in the New South Wales Supreme Court. On the right-hand side here, really what I just referred to is the desire to avoid potential conflicts and imbalances when it comes to estate planning. So a lot of the time you can have a family tree where you've got 3 kids, maybe 2 of those kids have got kids themselves, but 1 doesn't. So you want to leave a little bit more on one side of the family tree as a grandparent versus the other, because you want to cater for all the grandchildren. Often enough, the 3rd child that doesn't have children thinks, well, why is there an inequity there? Why am I getting an unequal share of this? And will often fight for what they believe is a principle-based argument. Turbulent relationships, so like I said, fractured families. Children with special needs, we've done a lot of setup around that, particularly when they can't access the special disability trust scheme. So that in particular is something that we have really been able to solve for some pretty difficult family situations. People under bankruptcy, so you might have a child that was in business where things didn't go right. So you don't want to transfer your wealth, particularly if your health is ailing or you've got a situation where you might have to transfer it whilst they're in bankruptcy. So we've had to cater for that situation as well. And something that is quite common these days is blended families or maintaining children of previous relationships. So just complex family situations that you've really got to be able to cater for as part of your estate planning. So here we'll kick off the first case study for estate planning. We've got Anne. She's 75 years of age. Anne has 2 children, Mary and Bob. Mary has 2 children. They're both under the age of 10, so super young, and Bob has none. So this spoke to that example that I just gave, actually. Anne wants to leave an inheritance to her grandchildren, but is actually concerned that Bob will challenge the will because he believes it should be 50-50. So what she wants to do is, on that sort of imbalance that we spoke about leaving a little bit extra to the grandchildren, is she'd love for $100,000 to be distributed to each of her grandchildren. So both the children that are under age 10. Concerns here that the transfer of wealth not be consistent with her wishes. The funds may be contested, which could actually fracture the relationship between Mary and Bob. And also is worried that, you know, grandchildren, they're under 10 at the moment, she might be passing away in 10 or 15 years' time. It's fine at that stage receiving the funds, but prior to that, they're way too young to receive a large amount of capital. So she wants to make sure that those children don't receive any of that money until they turn age 25. So what's the solution to this one? So we get Anne, the grandma, to be able to establish 2 investment bonds for both the grandchildren for a total of $200,000. And the vesting date, so you have one vesting age, which is age 25. So you can see here, just in the comments down the bottom there, that Bob will actually have difficulty making a challenge due to binding nominations. So you have 100% binding nominations when it comes to investment bonds. So it's going to be left to that beneficiary. And he mightn't even have any knowledge of these investments because they could be set up for those beneficiaries, and it could be given to Anne's daughter. and Mary could just hold on to that. And then as soon as we receive a copy of the death certificate, it's then paid out to the beneficiaries at the particular point in time, or the vesting date, or the particular point in time being death in some scenario, or the vesting date for those individual beneficiaries as it comes to fruition. So it can be really something that's quite discreet. It's completely transparent from our perspective, but we understand that the sensitivities of people's individual situations. So the outcome here is that her grandchildren have been able to be set up as beneficiaries, and they've been able to restrict how those funds are received by those individual beneficiaries by making that vesting date age 25. Okay, so blended family situation. I've read somewhere about 6 months ago that I think Australia has got the second most blended families per capita in the world. So a lot of situations where people are on to their second or third marriage, and obviously having children, with a different spouse. So we've got Steve and Sarah here. They have 2 young children. Steve has another child, Kate, who's 10 years of age from a previous marriage. And Steve wants to leave an inheritance for Kate that can't be challenged by his current family in the event of his death. Also, he probably doesn't want it to be challenged by his previous partner as well. He wants to make sure Kate receives those funds in full. So the solution on the right-hand side here, you can see Steve establishes an investment bond with a binding nomination for his 10-year-old daughter, Kate. This is very unlikely, like I said, to be successfully challenged by his current family or his previous spouse. In addition, like I showed you on the previous example, he could also use the future event facility. That's the name of that sort of vesting facility where you can control how and when those funds are distributed, to effectively transfer that at a later date. And if in a situation where Kate's not good with money, he could say a maximum of 20% per annum could be distributed to Kate over a period of 10 years, say. So you can certainly control the mechanisms and the catalyst for that money to go to Kate, and know that no other individual is entitled to those funds, so it's completely protected. So the outcome here is Steve's been able to meet the goal of protecting Kate's inheritance. And he and Sarah, his current wife, have mutual wills that look after each other in the event of their passing, and obviously the current children that they have. So again, it's something that they've been able to carve outside of their estate to be able to manage. I would call a unique situation, but it's not as unique as it used to be. So leaving inheritance. I really like this case study because it really talks to the strength of the investment bond in actual scenario. And please don't get overwhelmed from some of the numbers or the spreadsheet that I'll show you in a second. But you've got here, David and Margaret, they're both in their 70s, they're completely retired, they've got access to the full age pension. So through the full age pension as a couple, they receive just over $30,000 per annum. However, Margaret's just received a massive inheritance from her late mother of $700,000. Due to this, that'll cease that $37,000 of age pension that they're receiving each year from the government, and they're unable, because of their age, to recontribute that money to superannuation. Dave and Margaret also wish to pass some of their wealth directly to their 4 grandchildren and actually want to bypass their children for some reason. So what are the key objectives that they're trying to achieve given this massive inheritance that they've received, and what they're trying to achieve in terms of their own personal goals? So they want to receive something to replace their age pension to obviously cater for their living standards. They eventually want to pass that $700,000 on evenly to their 4 grandchildren when they pass away. They want to ensure that the grandchildren don't receive those funds until age 25, and they want something that is very easy to administer, funds that are completely liquid, or they can access them at any point in time. So how do we actually solve for that? So what we do here is we set up 4 individual investment bonds. The reason we do that is because we've got the 4 grandchildren. The initial investment is that $700,000 that's cut up into divided by 4, of course, $175,000 each. That then transfers upon the death of the last co-owner. So David and Margaret evenly own the bonds as the couple or the grandparents. And once the last one passes away, we don't know who's going to go first or second, of course, in their own when they eventually pass. So you want to make sure it's set up properly. And then once they actually pass away, the full restrictions on the funds will be on that $175,000 each. until each of the grandchildren turn 25. So obviously that'll be staggered over time. And as they turn 25, they'll receive access to that capital. So the outcome here is they've set the grandchildren as beneficiaries or transferees upon their death. They're not rewarded those funds until age 25. But in the meantime, to replace that age pension that they're now losing, they've got a regular monthly withdrawal to replace that age pension. And I'm going to show you here, and again, please don't get too overwhelmed by the way this looks, and just focus on line number 1. So what we've got here is an opening balance of the bond of $700,000 that we invested into it. It'll have net earnings, and this is done on actually one of our funds, which is, I think it was 6.2% per annum on an after-tax basis. So it's earned $41,000 for the year. They have the regular withdrawal that matches exactly what they received here in the third line from their age pension, which is $37,000. So they take that per annum. They've got a tax assessable portion of that. So there's $2,000 of tax that they have to pay in their own personal name. However, they receive a tax offset of $615. Of course, because they're in their 70s and it's going out to both of them, they actually don't have a tax liability. So that withdrawal is negligible. It actually doesn't happen, but they still receive the tax offset. I'm going to talk about the benefits of that in a second. So you can see there, they've got a net withdrawal amount of $37,000 there in the second last table, and their closing balance is $704,000 of the investment after they've done all that. Now, the big benefit here is you always receive a 30% tax offset of funds that you take out inside 10 years. It's just one of the rules in the investment bond. And again, we won't have time today to go into the detail of all of this, but that's $615. You can actually use, if you were to receive income somewhere else, you can use that tax offset to pay a lower tax liability for that asset. So if you were paying a $3,000 tax bill somewhere else, you're able to take $615 off that because of the tax offset you receive from the investment bond. So again, I know that sounds quite complex, but it speaks to the power of this structure. Not only are you not paying a personal tax liability, but you're getting what you'd call a tax credit for any other income that you might be generating at this particular point in your life. So it's a very, very attractive structure. And then you've got all the estate planning benefits on top of that. So whenever someone's investing in an investment bond, usually it's for an initial purpose, whether it's minimizing tax or whether it's for an estate planning purpose. So they're always going with that one purpose, and over time they can see some of the other benefits that they could potentially receive by investing through this structure. A few stats again. This is from Core Data. So this is one of the lead researchers in the country. So you can see 44.9% of Australians are worried about transferring their death. So there's two key things that they're actually worried about. So of that 44%, almost half of them are concerned about the impact of tax when they transfer their wealth, because a lot of people don't even know there's a taxable portion sitting inside their superannuation. Obviously, some of the assets they have outside of their superannuation too can be taxable. They're worried, are they dependent or non-dependent? There's so much complexity. That's why I think a financial planner is just so important, because legislation changes all the time, but doing this right can save you so much money and obviously mitigate or negate a lot of stress as well as part of that process. The other issue that they're concerned about is the misuse or mismanagement of those funds. And that's why we see that future event facility controlling the vesting periods of those funds upon passing is such an attractive feature of our investment bond. We're the only ones who do this because they're worried if they receive that lump sum, next minute they're down at the Audi dealership 6 days later buying a brand new Audi. So it's quite incredible how often that capital can be eaten up because people will buy an asset, that's of quite significance. I know I'm running out of time, so I'll get through these other scenarios pretty quickly. We've got another ruling from the grave. So again, brings this future event facility to life even more. We've got Margot, she's age 86. She's got a very devoted grandson. Sam is age 24. He's absolutely hopeless with money. He's a spendthrift, doesn't know how to manage money. However, Margot, of course, would like to help him financially because he's a great bloke. Margot's concerns is that if he got a lump sum, he's going to waste it. So she wants to be able to have the ability to be able to delay the inheritance. So we've got here, Margot establishes an investment bond for $100,000. she sets a future transfer date, so the future event facility that you can see there on your screen, when he turns 40. So you can't access any of those funds for the next 16 years if she was to pass away as soon as this particular investment bond was set up. And then what she does, Margot, she sets up restrictions where no more than 10% of the overall balance can be accessed per year. So she's been able to meet, I guess, that objective of helping out her grandson financially, but also been able to rule those funds from the grave to make sure that he doesn't spend a lump sum if it was to come to him. Another one is, and I already just touched on this, around superannuation death tax. This is a real life case study that we had here at Gen Life. So this is Jane, who's a widow, 81 years of age, has 2 adult children, Claire, 56, Lucy, 53, inherited a late husband's super account, and then recontributed those funds into her super account to have a total super balance of 1.4 million. Now, what are some of the concerns is that of that 1.4 million balance, her taxable component sitting in there is 650,000. And the tax rate that's going to be used for that 650,000 is 17%, which is therefore going to have a tax liability, which is a 6-figure amount of $110,000. So what we do here is we take the money outside of the super environment. We put it in to an investment bond, the total $1.4 million, where we establish it in 2 bonds for $700,000 each. We then have the beneficiaries or binding nominations as both of Jane's daughters, Claire and Lucy. And the outcome here, it is tax-free on death. So Jane is able to provide a tax-free bequest upon her death and know that that $110,000 tax liability won't be incurred if it was to be transferred through her superannuation. So just a quick recap of some of, I guess, the benefits and features of an investment bond when it comes to estate planning is the fact that it's a non-estate asset, so you can carve it outside of your estate to be able to manage that transfer. Tax-free proceeds, so if you were, to set up an investment bond today and you passed away tomorrow, you know there's no tax liability on there, whether they're a dependent or a non-dependent. You can automatically transfer at specific ages, or you can control the distribution of that wealth over certain tranches over various points in time that you see fit. No CGT or annual tax reporting, so a very cost-effective way to manage the money, and also avoids conflict depending on your own personal family situation. Another thing that we're seeing here in a growing trend, particularly because the core use over the last 18 months for our investment bond at the top has been estate planning. We noticed that a lot of grandparents are really socially conscious in terms of making sure that the investments that they go into really are conscious of environmental, social, governance, responsible investing. We've had a pandemic that we're still stuck in the middle of. We've had bushfires, we've had floods, we've had a lot of things that really come top of mind. So they're very, very conscious about the assets that investment is going into. And we're very much catering for that demographic and those concerns here at Generation Life with our investment menu. So it's a big growing trend. I won't go into all the detail of this because I know I've used up most of my time. You can see there 20% spike in year-on-year flows from December 19 to December 20. Personal choice. So whether it's having a personal social impact and being able to align with your individual values. And of course, these considerations really are top of mind when it comes to intergenerational wealth transfer. Some of the stats, like I said, I always love to bring these things to life a little bit more through a few stats. So you can see 92% of Australians expect their investments to be, responsible and, ethical. 63% of Australians expect their financial advisor to be able to consider the ESG impacts of their investment. 49% of Aussies expect their advisors to invest in funds which align to their underlying personal values. And of course, Australians expect their advisor to be knowledgeable about responsible investment options and what that looks like. And you can see on the last part there that there's a lot of challenges in this space because a lot of businesses or a lot of funds can do a thing called greenwashing, which is basically saying that they invest responsibly, but don't necessarily do that when you dig into the underlying portfolio, which is something a full investment team does here with any new investment option that we put on board here at Generation Life. One of the common, I guess, fallacies almost that people have when it comes to investing in a socially responsible way or a responsible manner around ESG is the performance. And you can see here, and I'm going to create a very, very simple explanation of what this bar chart means. But effectively, you look at the two on the left-hand side, the two bars, and the two on the right-hand side for the 1 year, 2 year, and 3 years. The two on the left-hand side, the blue bar graph, is the index around ESG. The red chart are the specific global equity funds. And the green one, the light green one there, you can see is just the broader index, which incorporates everything, the full investment universe. And the right-hand side there are some of the non-ESG global equity funds. So you can see the performance of the ESG global equity funds and the overall index has outperformed your sort of generalist investing that incorporates the full investment universe. So certainly the investment returns are there to be had, and you're doing it in the right way. This is one of the investment options that we have on our investment menu. We've got several ESG or RI funds, responsible investing funds, that you can choose from. But this is an overall investment portfolio, a growth model that we put together more recently. You can see there all the characteristics on the left-hand side. It's mainly in growth assets. It's got a target return per annum of cash plus 3.5%. It's offered through our tax-effective structure. So it's the first time that anybody's been able to put in a full portfolio, growth portfolio, in responsible investing inside a tax structure to be able to minimize your overall tax liability. I'll just look at the performance. We only set this up this year, so it's only a few months of performance. The return before tax, so the gross return, was 5%. The return after tax is 4.44%. So you can see there, effectively, you've only paid 0.5% away in tax. If you're on a high marginal tax rate, you're paying company tax rate, it would be a much bigger chunk than that. So you can see that the benchmark of the after-tax return, so what the benchmark is that's our goal. That's what we wanted to get over this 3-month period, was above 0.93%. We ended up outperforming that, you can see on the right there, by 3.5%. So effectively, that's the difference between the 4.4 and the 0.93 goal that we had in terms of overarching performance for this fund. So you can see there, this just speaks to the last slide in terms of, I guess, some of the concerns that people might have that the investment returns aren't there. You can see not only the investment return there, it's very, very tax effective. Got 2 more slides to cover off. This talks to the full spectrum of investments that we have. Some of the brands you can see on the right-hand side that sit within our tax structure, some of the biggest in the game, some of the biggest fund managers in the world. And you can see there on the left-hand side, we have every single asset class covered and all the responsible investment options that you may need. Again, already touched on this, highly recommended from both research houses. And that's Generation Life, that's investment bonds. That's some of the case studies that I hope brings it to life. And you can think about some of your own personal challenges or sets of circumstances that you can talk to David and his team about being able to solve for. Thanks for everybody's time today. Much appreciated. I think I've gone 10 minutes over, but hopefully you stayed engaged. Thanks, David. I'll pass it back to you.
Yeah, thanks, Grant. Look, really appreciate your time today. That was a fantastic presentation, and so I'll let you keep going with the time because I found that really interesting myself, and I'm really pleased you got. We did go a little bit over because it was good to get a little bit of time on the ESG. I know that's something that's very close to our heart, and we like to think that in some way we helped get that investment option onto Generation Life.
You very much did, David. Don't you worry.
Yeah. So
it's performed incredibly well, so we have to thank you for that.
Yeah. So a shout out to Claire and her work in that as well. But thank you. Yeah, thank you very much for your time today, Grant. That was absolutely fantastic. Thank you for being generous and sharing some of your life experiences with us in addition to your presentation. We really appreciate that. To Laura, thank you for organising this presentation, and Helena for putting this all together and getting all the invitations out. So thank you for your time. Really appreciate you sharing this with us, and please come back to myself or any of the financial planning team if you've got any questions. Thanks, Grant.
Absolutely. Thank you, David, and a big thank you to Claire as well, and for everybody who joined us today. Appreciate it. Take care, and all the very best.
See you.
See you.
Bye.
Bye.